So now that we're done with our issue of shares and their buying back, I want us to look at our dividends. So dividends are basically payments to shareholders by the company as a reward or a return of investing capital with them, right? So dividends are paid annually, but not every year the company is obligated to pay dividends, right? And we will look at this shortly. So firstly, I want us to look at some basic definitions that we might need to be familiar with. The first one is our interim dividends. So what is meant by interim dividends? It's basically distributions of dividends during the year. So it's any money that was paid in the current year for dividends, right? And then the final dividends is distribution after the year has ended. And this is because of companies would wait to know how much profits they have made. And then depending on the profits they've generated, they'd say, okay, we would pay so and so much dividends this year. Right. And then when dividends are declared, now this one is tied to those final dividends. And I want us to pay close attention to what these two mean, right? So when dividends are declared, it means that the company has just made an announcement to shareholders saying we will pay dividends. And this is important because of we always need to remember that there has been no money effect. So dividends will be paid. They're not yet paid, meaning that our bank account is not triggered, it is not affected as no money went out. So let us look at this in a form of a timeline. Okay, let me just fix that there. So let us look at this in a form of a timeline. So if we look at our timeline, okay, let's get a thicker pen better. So yeah, so if we have a timeline here, we know that there's two important events, right? So this is the beginning of the year, beginning. And then here we will maybe have our end. Okay, let's make it thicker as well. And then here it will be the end of the year, right? And then somewhere here there will be interim dividends. So there'll be interim dividends. And then here there will be final dividends. But these are declared, not paid. So very much important. Let's have in our brackets, not paid, right? So again, this will be our beginning of the year, and then during the year there will be interim dividends made, or you're paid, and then at the end of the year, because of the company now knows how much profits they have made, if they are generous enough, they would tell their shareholders that, okay guys, we will pay you final dividends of this much after a certain period of time. So now, important thing again, these final dividends are not paid in the current year. They are only paid in the following year because of these are determined after the year has ended. The only thing we can do this year is to recognize that we owe shareholders this much, right? And then because of that, I want to then introduce these two new concepts as well. So we have what we call is shareholders for dividends. So this is self-explanatory account. It is shareholders for dividends. These are the shareholders that we owe dividends. And we only owe dividends to shareholders when we have declared dividends, right? And then the second account I want us to look at is dividends on ordinary share. So now this is our dividends account. It is an equity account that represents the portion of profits that have been distributed to what? To our shareholders. So all of dividends zetu. So all of our dividends. So we would have here our interim dividends. And then here we would have our declared dividends. So whether this has been paid or not, but the fact that we've declared, we know that there's so much dividends that we need to pay off. So this account will always recognize these two types of dividends. So I want us to look at the behavior of these two accounts. So we said one is a liability and the other one is an equity. So I want us to look at the behavior of these accounts, how we would generalize them, and then look at any other extra information. So the first thing, let's start with our journals. Now, so number one would be, okay, let's make that more thicker. So our number one would be our journals, right? So when our journals and ledger accounts are concerned, we always have to think about what happened and for what purpose, right? So the first journal here would be our interim dividends. So when our interim dividends are concerned, payment here has been made, right? So if payment here has been made, we would always need to credit our bank because of money has left the company, right? And then you must remember to say, as I say, that this dividends on ordinary share account is for both the interim and declared dividends. It's just an account that shows the total dividends for that company, right? And then on our debit day, we would then have that account. Okay, let's increase our thickness. We would then have that account there, which is a dividends on ordinary shares now. So when interim dividends are paid, we would debit our dividends on ordinary shares and then credit our bank. The way of analyzing it, what has happened, we've paid money. Why did we pay money? For dividends on ordinary shares. So since we've paid money, our bank is decreases on the credit side, hence we are crediting our bank, and then these are dividends. It will be our balance, our debit entry, and then we said it's an equity account. So if it's an equity account, we will debit it. Why do we debit? Because of it reduces what our owners or shareholders expect from that account. And then the second one would be our second dividends, which is declared. So when dividends have been now declared, it means that an announcement has been made by the company to their shareholders stating that we will pay you guys so much dividends, right? So there, again, we have to remember no payment has been made. So we always have to look at what has happened and for what purpose. So what happened is that we've made a promise. The promise we made creates an expectation to shareholders that they will receive money. And because of that expectation, it means that we owe them final dividends because of we've declared. So since we've declared these final dividends, our liabilities are going to increase because of this that now expectation to pay money. So liabilities increase on the credit side. We'll go on our credit side and then right there, shareholders for dividends. So this is a liability account that shows how much we owe our shareholders in relation to dividends. Not anything else, but in relation to dividends, right? And then we would then have our debit side, and then on our debit side, we'd have to remember that we ask ourselves for what purpose? What happened? For what purpose? So we've promised shareholders for dividends. So we'll have our dividends again there. Dividends on ordinary shares. So this is what happened. So this here is during this period here. So the journals we've made is this period here, right? And then when the following year now comes, so now we go to the third year. On the third year, on the second year, final dividends are paid. So when final dividends have been paid, it means that there's no longer an expectation from shareholders for us to make payments to them. So meaning that we no longer owe them. So if we no longer owe them, it means that we need to reduce that liability, right? And also credit bank because of we've made a payment. So again, what happened? We've made a payment. Why? Because of we were owing our shareholders some dividends. So since we no longer owe those shareholders dividends, we will need to debit our shareholders for dividends account. And then we will then need to credit bank because of we've made payment. So this is bank money paid. So again, now this is after. So this is after year end next year. That's right, this is after year end, which is next financial period. Right. So this is a really important distinguishing thingy that we need to do. Excuse my English there. And then lastly, there's two accounts. So I want us to look at the ledger of these accounts in terms of how would they then look like if we would be required to prepare them, right? So the first one here would be the obvious one, our liability. And then the second one here would be our dividends on ordinary share one, which is our equity, right? And then both these accounts behave the same. So this side will be our debits, would be our credits, would have our debits, and then would have our credit. So the first account we're saying is our shareholders for dividends, right? And then the second one we are saying it's our ordinary, it's in dividends on ordinary share, right? So it's going to be dividends on ordinary shares. Excuse my writing and spelling there, right? So we know that these accounts will increase on the credit side because of it's an equity and a liability account, and then they will decrease on the debit side, right? Cool. So now let us look at the types of e-transactions and the nature of those transactions that we would record both in these accounts. So with the shareholders for dividends, we know that this is a liability account. It will be increased by dividends on ordinary share when we declare them. So let's say dividends, yeah, dividends declared. When interim dividends are paid, this account is not affected at all. But one thing I forgot to include, we need to always remember that this account is a liability account, meaning that it will always have an opening balance. So we need to include our opening balance there. So we would always have an opening balance in this account. And then what would reduce this account? As we see there, it will only go down when payments have been made. So let's record our bank here. So this bank is for paid dividends. Paid dividends. Then on the other side, it was the declared. And also these paid dividends here, it's not the interim one, it's the final dividends paid. So let's say final dividends paid. So this only relates to final dividends paid. And then they would have our closing balance. And then that will just be that for that account. And then if we go to this now dividends on ordinary share account, we then need to think as to what is happening, right? So there, if we see here, we had debited this account, right? We had increased our dividends on ordinary shares there. And then on the other side, we would then need to record that so this is an equity account, so since it's an equity account, it means that it will be closed off to a certain account, and then we will close this off to our appropriation account. So now let us record this here. So again, for our interims, initially the bank was credited and then we debited this account. So we would need to then debit this account by bank, which is what has been paid, because of it reduces this account there. Okay. On the side, on our debit side, as we see there, that we've debited dividends and ordinary shares when we were paying interim and also when we were declaring. So here we would have to have our bank, and this bank is for interim paid, right? Interim dividends paid. And then secondly, we would then need to have our shareholders for dividends, because of this is now what was declared. If we see there on what we declared, we debited this account, dividends on ordinary shares, we credited it with what? With our shareholders on dividends. So there we would have our shareholders for dividends. Shareholders, let's say for dividends, yeah. So this would then be your dividends which have been declared, the ones that have not yet been paid, the ones that were declared. And then this account will be closed off to our appropriation account. And then we would look at what this account does towards the end of our videos. So I think that is all for our dividends. It's simple, straightforward like this. We just need to know as to what is happening and for what purpose. Remember that shareholders for dividends account is a liability account. Dividends and ordinary shares is an equity account, and then these two are debited because of they are showing that we've made payments to our shareholders for these dividends on ordinary shares, and then those two payments are closed off. Okay, this one is not a payment; it's just a declaration, but those two are closed off to the appropriation account. We will look at examples of this. Thank you.